Hi everyone, my name is Fositina. Today we're diving into one of the most critical areas of auditing, accounts payable. If you're in business, managing your cash outflows is just as important as bringing revenue in. You don't want to be spending money on things that don't align with your business goals. So let's break down the processes involved in accounts payable and how we, as auditors, ensure everything is running smoothly. So let's get started. First, let's talk about the accounts payable process. It's not just about paying bills, it's a series of steps that ensure every dollar spent is accounted for and properly authorized. Here's how it typically works. It all starts with someone in the business needing something, whether it's goods or services. They'll submit a purchase request, which kicks off the process. Not every request gets the green light. There's usually an approval hierarchy based on the amount being spent. For example, a manager might approve purchases up to $3,000, but anything over $10,000 might need sign-off from the director or the CEO or CFO. This ensures that larger expenses are carefully reviewed. Once approved, the next step is placing the order. This might involve getting quotes, evaluating suppliers, or using an approved vendor list. Many organizations, especially government agencies, have pre-approved suppliers to streamline this process. When the goods arrive, they need to be checked and recorded. This is where a receiving report comes in. It documents what is received, the quantity, and the condition. Sometimes, the quantities are left blank on the order form so the receiving team can verify the actual count. This helps prevent errors or discrepancies. After the goods are received, the supplier sends an invoice. This usually goes straight to the accounting department, where it's matched with the purchase order and receiving report. These days, most invoices are electronic, which makes the process faster and more efficient. The three-way match is a critical step in the accounts payable process. The accounting team compares three documents: the purchase order, the receiving report, and the invoice, to ensure everything matches. Did we order 100 units? Did we receive 100 units? Are we being billed for 100 units? If there's a mismatch, it's time to investigate. Once everything checks out, the payment is prepared. This usually involves creating a voucher package that includes the purchase order, receiving report, and the invoice. The payment is then approved by someone with the right authority, often requiring a second sign-off to prevent fraud and errors. We must remember to book the supplier invoice correctly and ensure the payment is recorded in the accounting system as well. Now, let's talk about segregation of duties. This is a key control in the accounts payable process. The person who requests the purchase shouldn't be the same person who approves it, orders it, or receives the goods. By separating these roles, we reduce the risk of errors or fraud. For example, if one person had control over the entire process, they could easily approve fake invoices or pocket cash. That's why segregation of duties is so important. Okay, that's a detailed overview of the accounts payable process and the key controls we look for as auditors. Businesses should ensure that they check their payables internal control process to ensure that it's working as it's supposed to.